Thomas Bulkowski is one of the most respected names in the world of technical analysis. Before becoming a full-time trader, he worked as an engineer for a major aerospace company. His analytical background helped him bring a scientific mindset to the art of chart reading. He did not believe in random guessing or emotional trading. Instead, he believed that price charts tell a story, and if you listen carefully, you can understand what the market is planning next. Bulkowski spent decades studying thousands of stock charts. He analyzed patterns from historical data and compared how often they succeeded or failed. This research-based approach made him unique among traders. He transformed the world of chart reading into a field of statistics and probabilities. Rather than saying, "This looks like a triangle," he measured how many times a triangle truly led to a breakout. This focus on accuracy and data is what makes his work stand out from the crowd. His passion was simple: to give traders clear and tested tools that could help them identify the turning points of the market. He turned raw price movements into patterns, patterns into statistics, and statistics into practical wisdom. This journey of study and discipline gave birth to his legendary book, The Encyclopedia of Chart Patterns. In this book, Bulkowski takes us into the heart of price behavior. He begins with the basics, what a chart really is, and how to read it with understanding. Then he slowly guides us into the complex world of continuation and reversal patterns. By the time you finish reading, you do not just recognize patterns. You start thinking like the market itself. So, as we step into the first part of this encyclopedia, we begin by understanding the foundation. Before you can spot triangles, flags, or head and shoulders patterns, you must first learn how to read the language of charts. And that is exactly what the next section, Part 1, Introduction, will teach you. It will show you how price and volume come together to form the heartbeat of every market movement. Let us begin the journey where every great trader begins, by learning to see what others overlook. Chapter 1, Introduction to Chart Patterns. Every price chart is more than just a collection of lines and numbers. It is the diary of market emotion. Each tick on that chart records fear, greed, hope, and hesitation. Thomas Bulkowski begins this chapter by explaining that charts are the purest reflection of human behavior in the marketplace. When you learn to read them correctly, they reveal the crowd's psychology, where traders are confident, where they are uncertain, and when they are ready to act. A chart pattern is simply a shape that price creates on the chart before making a move. It could be a triangle, a flag, a rectangle, or even something as rare as a diamond. Each pattern tells a story about what the buyers and sellers are doing. For example, when prices move within a narrowing triangle, it often means buyers and sellers are fighting for control. When one side wins, the pattern breaks, and the next big move begins. Bulkowski emphasizes that these patterns are not magical predictions. They are probabilities built from real history. He studied thousands of past examples to see what usually happens after a certain shape appears. That is why his approach is trusted by professionals. It is based on statistical reality, not just opinion. The goal is not to be perfect, but to increase the odds of success. He also explains that recognizing chart patterns is both an art and a science. The science lies in understanding the data, and the art lies in recognizing subtle differences. No two patterns are ever identical, but the logic behind them remains the same. Patterns repeat because human emotions repeat. Whenever greed pushes prices too high, or fear drags them too low, the same shapes start to appear again and again. A good trader, Bulkowski says, learns to watch these patterns form with patience. Jumping too early or too late can destroy accuracy. The real power of chart reading comes from observation, waiting for the pattern to complete and the breakout to confirm. Once you learn to wait, the chart begins to speak clearly. He warns that beginners often see patterns everywhere, even when they are not valid. A random wiggle on the screen is not a pattern unless it follows certain rules. Each genuine chart pattern has a clear start and end, measurable boundaries, and a specific breakout point. Without discipline, chart reading becomes guessing, and guessing is what destroys most traders. Bulkowski also reminds us that patterns should never be viewed in isolation. You must consider the trend that came before them. If a pattern appears after a long upward move, it might signal exhaustion or reversal. If it forms during an uptrend, it might mean continuation. The context gives the pattern its true meaning. Charts do not only show what happened, they hint at what could happen next. They tell us where pressure is building and where opportunity is waiting. To see that clearly, a trader must develop the ability to connect price and emotion. That ability comes from constant study and observation. Every pattern you identify should be verified with past examples, performance data, and volume confirmation. This chapter sets the foundation for everything that follows. It teaches that price patterns are the footprints of money flow. By studying them, you learn to walk behind the big players of the market. You begin to notice the rhythm, the quiet build-up before the storm, the calm before the breakout. You realize that charts are not about lines, they are about people, decisions, and psychology written in numbers. As we move forward, the next step is to understand how to read charts more precisely. Before you can master triangles or flags, you must learn to recognize trends, support, resistance, and the true language of price movement. So let us turn the page to the next chapter, How to Read Charts, where the structure of visual trading truly begins. Chapter 2. How to Read Charts. Reading a chart is like learning a new language. Each line, bar, and candle has meaning. Thomas Bulkowski explains that charts are visual representations of price action over time. They allow traders to see trends, reversals, and periods of indecision at a glance. But to read them correctly, you need to understand their components and what each one tells you about market sentiment. The first step is identifying the trend. A trend is the general direction in which prices are moving. If prices make higher highs and higher lows, the market is in an uptrend. If prices make lower highs and lower lows, it is a downtrend. Trends are not perfect straight lines. They fluctuate and form temporary pauses, but the overall direction is what matters. Next comes support and resistance. Support is a price level where buying interest is strong enough to prevent the price from falling further. Resistance is the opposite, a level where selling pressure prevents prices from rising. Bulkowski emphasizes that these levels are not exact numbers. They are zones where the market has historically reacted. Watching how prices approach these zones helps traders anticipate reversals or breakouts. Price patterns form within these trends and zones. Continuation patterns indicate that the trend is likely to keep going. Reversal patterns suggest that the trend might be changing. Bulkowski explains that knowing which category a pattern belongs to increases your odds of predicting the next move. Patterns do not guarantee outcomes, but they tilt the probabilities in your favor. Volume is another critical aspect of reading charts. It is the measure of how many shares or contracts are traded during a specific time. Volume confirms the strength of a move. For example, a breakout accompanied by high volume is more reliable than one on low volume. Volume can also reveal hidden activity, like accumulation by large traders before a major move. Bulkowski warns against seeing patterns in isolation. Charts must be read as a whole story. Observe the trend, note the support and resistance, watch the volume, and then identify the pattern. Every component tells part of the story. Ignoring any one element increases the risk of misinterpretation. Charts also vary depending on the time frame. A daily chart shows long-term trends, while a minute-by-minute chart reveals short-term movements. Traders must choose the right time frame for their strategy. Day traders might focus on short-term charts, while investors looking for multi-year growth focus on weekly or monthly charts. The principles remain the same, but the perspective changes. Another important skill Bulkowski highlights is recognizing false signals. Not every breakout or pattern completion leads to a strong move. Sometimes the market tests a level briefly and then reverses. These failures are part of trading, and experienced traders learn to manage risk rather than chase every opportunity. Finally, reading charts is not just technical, it is psychological. Price movements reflect human emotions in aggregate. Every high, low, or sideways movement is caused by the interaction of buyers and sellers. The more you study charts, the more you start seeing patterns in human behavior. You learn patience, observation, and timing, qualities that no indicator can replace. By mastering how to read charts, you lay the groundwork for spotting all the important chart patterns. You learn to see the story behind the numbers and anticipate potential moves before they happen. This foundation is essential because patterns like triangles, flags, and head and shoulders only make sense if you can read the chart first. The next chapter, Understanding Price and Volume, builds on this knowledge by showing how price action and trading volume together reveal the strength or weakness of every market move. Chapter 3. Understanding Price and Volume. Price and volume are the two pillars of technical analysis. Thomas Bulkowski explains that price shows what the market has done, while volume reveals the conviction behind every move. Together, they tell the full story of market behavior. Ignoring either one is like trying to understand a conversation by hearing only half the words. Price alone shows direction. It tells you if buyers or sellers are in control at a given moment. Highs and lows, gaps, and closes form patterns that hint at future movement. But price without context can be misleading. A sudden price increase might look impressive, but without significant volume, it could be a weak move or manipulation. Volume is the voice of the market. It measures the intensity of trading activity. High volume during an uptrend indicates strong buying interest, while high volume during a downtrend signals strong selling pressure. Low volume during a move often suggests hesitation or lack of participation. Bulkowski emphasizes that patterns confirmed by volume are far more reliable than those without it. He also discusses the relationship between price and volume over time. For example, during the formation of a triangle, you may see decreasing volume as the range narrows. This suggests indecision and the buildup of tension. When a breakout occurs, it is typically accompanied by a surge in volume, confirming that the market has chosen a side. Recognizing these subtle signals allows traders to act with higher confidence. Another key concept is volume spikes. Sometimes, sudden bursts of volume occur without a major price move. These spikes can indicate accumulation or distribution by large traders. Observing these moments helps in predicting potential breakouts or reversals before they happen. Bulkowski also warns that ignoring volume can lead to false patterns. A head and shoulders formation without volume confirmation might fail, causing losses if traders act too early. Price and volume also help in measuring the strength of trends. A strong uptrend will see higher highs with increasing volume. A weakening trend may see price rise, but with declining volume, signaling that the rally is losing steam. Similarly, in a downtrend, increasing volume with lower lows confirms the selling pressure, while declining volume suggests a potential bottom. Bulkowski emphasizes that understanding these two factors is crucial for spotting continuation and reversal patterns later in the book. Patterns like flags, pennants, and triangles rely heavily on volume behavior to confirm their validity. Volume also helps traders set entry points, stop losses, and price targets more effectively. Finally, he explains that price and volume together reflect the psychology of the market. Every movement is the result of decisions made by thousands of participants. Rising prices with strong volume show confidence and fearlessness. Falling prices with heavy volume reveal panic or capitulation. Learning to interpret these signals trains the trader to read the market as a living entity, rather than just numbers on a screen. By mastering the connection between price and volume, traders gain the ability to filter out noise, spot genuine opportunities, and avoid traps. This chapter builds the bridge between basic chart reading and the more advanced concept of patterns. Once you understand how price and volume interact, you are ready to move into the next part of the book, Continuation Patterns, where we learn how trends persist and how to identify signals that the market will keep moving in the same direction. Part 2. Continuation Patterns. After learning the foundation of chart reading, understanding price, and interpreting volume, we are now ready to explore continuation patterns. Continuation patterns appear during an existing trend and suggest that the trend is likely to continue rather than reverse. They are the market's way of taking a pause, a breather, before resuming its previous direction. Bulkowski emphasizes that recognizing these patterns gives traders the opportunity to join strong moves at an early stage, increasing the chances of profitable trades. Continuation patterns often form when the market consolidates after a strong push upward or downward. This consolidation shows that traders are temporarily indecisive, but the trend's underlying momentum remains intact. By spotting these formations, traders can anticipate the breakout and position themselves accordingly. Ignoring them may result in missing significant opportunities or entering trades too late. In this part, Bulkowski covers the most common continuation patterns that appear in all types of markets, including stocks, commodities, and forex. These patterns include triangles, pennants, flags, rectangles, and gaps. Each pattern has a unique shape and psychology behind it, but all share the same purpose: to indicate that the current trend is likely to persist. Triangles, for example, show the tug-of-war between buyers and sellers. Flags resemble a brief pause in a strong trend, often forming a small rectangle that slopes against the prevailing trend. Pennants look like small symmetrical triangles that develop after a sharp price movement. Rectangles indicate price bouncing between support and resistance levels before continuing in the trend direction. Gaps occur when price jumps above or below a previous area with little or no trading, signaling strong momentum. Bulkowski stresses that continuation patterns are not guarantees, they are probabilities. By studying thousands of historical examples, he measured which patterns work best under certain conditions and how volume confirms their reliability. Volume often decreases during the consolidation phase and surges at the breakout, providing the signal that the trend is resuming. Mastering continuation patterns is crucial for traders who want to ride strong trends. They allow traders to enter trades with lower risk, place stop-loss orders strategically, and forecast potential price targets. The key is patience. Waiting for the pattern to complete and confirming the breakout with price and volume. Understanding continuation patterns is the bridge between basic chart knowledge and advanced trading strategies. It shows how trends behave, how the market pauses, and how to anticipate moves without guessing. Once you grasp this, you are ready to explore the first pattern in detail. The next chapter, Triangles, dives into one of the most versatile and widely seen continuation patterns. It explains how triangles form, what they reveal about the battle between buyers and sellers, and how to trade them effectively. Chapter 4. Triangles. Triangles are one of the most common and versatile continuation patterns in the market. Thomas Bulkowski explains that they form when price movement narrows over time, creating a triangular shape on the chart. This narrowing occurs because buyers and sellers are in a temporary balance, each pushing price in opposite directions. The tension builds as the range tightens, and eventually, one side wins, causing a breakout. There are three main types of triangles: ascending, descending, and symmetrical. An ascending triangle has a flat top and rising bottom. It indicates that buyers are gradually gaining strength, and a breakout upward is more likely. A descending triangle has a flat bottom and declining top, suggesting that sellers are gaining control, and a downward breakout is probable. A symmetrical triangle has both the top and bottom converging, showing indecision between buyers and sellers. The breakout can occur in either direction, so confirmation is essential before taking a position. Triangles are considered continuation patterns, which means they usually appear in the middle of a trend. In an uptrend, an ascending or symmetrical triangle often signals that the bullish move will continue. In a downtrend, a descending or symmetrical triangle may indicate the bearish trend will persist. Bulkowski emphasizes that while triangles often continue the trend, they can occasionally reverse it, so traders must always use stop-loss orders and volume confirmation. Volume plays a critical role in triangle patterns. During the formation of the triangle, volume typically decreases as the trading range tightens. This reduction indicates a pause in market activity, as neither buyers nor sellers are willing to dominate yet. When the breakout finally occurs, volume usually surges, confirming the direction of the move. A breakout without significant volume is less reliable and may lead to a false signal. The breakout direction is determined by watching the price action near the triangle's converging lines. A close above the resistance line in an uptrend or above the upper boundary of a symmetrical triangle signals a bullish breakout. A close below the support line in a downtrend or below the lower boundary of a symmetrical triangle signals a bearish breakout. Traders often place entry orders slightly beyond these lines to catch the momentum. Bulkowski also provides statistical insight into triangle patterns. He found that ascending triangles in an uptrend have a high probability of breaking upward, while descending triangles in a downtrend often break downward. Symmetrical triangles are more balanced and require careful observation of the breakout and volume for confirmation. Traders who follow these guidelines increase their odds of capturing profitable moves. Triangles are not only useful for spotting continuation trends, but also for measuring potential price targets. The height of the triangle at its widest point can be projected from the breakout point to estimate how far the price might move. This method gives traders a realistic idea of where to set profit targets and manage risk effectively. Finally, Bulkowski warns that triangles can sometimes fail. A false breakout occurs when the price briefly moves beyond the boundary, but then reverses. To reduce risk, traders should wait for confirmation, such as a close beyond the line accompanied by strong volume. Patience and discipline are critical for successfully trading triangle patterns. By mastering triangles, traders gain an essential tool for navigating trending markets. They learn to read the struggle between buyers and sellers, anticipate breakouts, and measure potential moves with confidence. Once you understand triangles fully, you are ready to move on to the next continuation pattern. Pennants, which are similar in psychology, but form over shorter timeframes and often follow sharp price moves. Chapter 5. Pennants. Pennants are short-term continuation patterns that appear after a strong price movement, often called a flagpole. Thomas Bulkowski explains that they are similar in psychology to triangles, but smaller and quicker to form. They represent a brief pause in a trend, where buyers and sellers take a short break before the market resumes its previous direction. A pennant begins with a sharp, almost vertical move in price. This move shows strong conviction from either buyers in an uptrend or sellers in a downtrend. Following this surge, price consolidates in a small, symmetrical triangular shape, usually lasting from a few days to a few weeks. During this pause, the market is catching its breath, and traders are assessing the next step. Volume is critical in pennants, just like in other continuation patterns. During the initial surge, volume is high, reflecting strong participation and momentum. As the pennant forms, volume decreases, indicating that trading activity is temporarily slowing. When the breakout occurs, volume typically surges again, confirming the continuation of the trend. A breakout without increased volume is less reliable and may signal a false move. Pennants are considered high-probability patterns when they occur in strong trends. In an uptrend, a bullish pennant suggests that buyers will regain control and push prices higher. In a downtrend, a bearish pennant indicates that sellers will continue to drive prices lower. Bulkowski emphasizes that the context of the preceding trend is crucial for interpreting the pattern correctly. The breakout direction is usually the same as the trend that preceded the pennant. Traders often enter positions just beyond the boundary of the pennant after confirmation. Setting stop-loss orders below the pennant in an uptrend or above it in a downtrend helps manage risk effectively. Measuring the price target for a pennant is straightforward. Bulkowski explains that the length of the flagpole is projected from the breakout point to estimate the expected move. This gives traders a clear target and a way to calculate risk-to-reward ratios. The combination of pattern, volume, and prior trend makes pennants powerful tools for trend-following strategies. Pennants can fail if the breakout reverses quickly, but careful observation of volume and price action reduces the risk. A breakout with weak volume or hesitation near the boundary is often a warning signal. Experienced traders wait for confirmation before committing capital to the trade. One key advantage of pennants is their speed. Because they form over shorter periods than other patterns, they allow traders to take advantage of quick trend continuations. This makes them ideal for swing traders and day traders who seek to capitalize on momentum moves without waiting for long consolidations. Pennants also teach traders patience and discipline. Even though the prior move is strong, the pattern shows that a short pause is normal. Rushing into a trade before the breakout can lead to losses. Observing the pennant and waiting for confirmation trains traders to act strategically rather than impulsively. By understanding pennants, traders gain insight into short-term market pauses and trend continuations. They learn to read the brief struggle between buyers and sellers and anticipate the resumption of the trend. With triangles and pennants mastered, the next logical step is flags, another continuation pattern that resembles a rectangle and forms after strong moves, providing additional opportunities to ride trends successfully. Chapter 6. Flags. Flags are continuation patterns that form after a strong price move, similar in psychology to pennants, but with a rectangular shape. Thomas Bulkowski explains that flags represent a brief consolidation before the trend resumes, showing that the market is taking a pause rather than reversing. They are highly reliable patterns when they occur in established trends, and are favored by traders looking to ride momentum moves. A flag begins with a sharp move called the flagpole. This move can be upward in a bullish trend or downward in a bearish trend. Following the flagpole, price moves sideways or slightly against the prevailing trend, forming a narrow rectangular channel. This consolidation shows that buyers or sellers are catching their breath, and the market is temporarily balancing supply and demand. Volume is a key component in flags. During the flagpole, volume is usually high, reflecting strong conviction in the move. As the flag forms, volume typically decreases, signaling a temporary lull in trading activity. When the breakout occurs, volume surges again, confirming that the trend is resuming. A breakout with low volume may indicate a false signal and should be approached cautiously. Flags are usually considered continuation patterns, which means they are most reliable when they appear in the middle of a trend. In an uptrend, a bullish flag suggests that buyers will regain control and push prices higher. In a downtrend, a bearish flag indicates that sellers will continue to dominate and drive prices lower. Bulkowski stresses that context is crucial. A flag forming after a long trend without momentum may not perform as expected. The breakout direction is usually in line with the prior trend. Traders often enter positions just beyond the flag's boundary after confirmation. Stop-loss orders are placed strategically below the flag in an uptrend or above it in a downtrend to manage risk. The length of the flagpole can be projected from the breakout point to estimate a potential price target, helping traders plan their exit. Flags differ from pennants in shape and duration. Pennants form tight, small triangles over a short period, while flags form rectangular channels that can last longer. Despite these differences, the underlying psychology is the same: a pause in a trend before momentum resumes. Both patterns rely heavily on observing volume and trend context to increase the probability of success. Bulkowski also highlights that flags can fail. A false breakout occurs when price moves beyond the rectangle but then reverses. Traders are advised to wait for confirmation, such as a strong close accompanied by increased volume, before taking action. Discipline and patience are essential for trading flags successfully. Flags are particularly useful for short-term and swing traders. They allow entry into a trend after a brief pause, capturing the majority of the next move. By learning to read flags, traders gain insight into the ongoing battle between buyers and sellers and can position themselves strategically. Understanding flags also reinforces a broader lesson about market psychology. Even strong trends take breaks, and these pauses provide opportunities rather than obstacles. Recognizing and respecting these pauses is key to disciplined trading. With triangles, pennants, and flags understood, traders now have a strong foundation in the most common and reliable continuation patterns. The next chapter, Rectangles, builds on this knowledge by exploring patterns where price moves sideways between support and resistance, forming clear zones for potential breakouts and trend continuation. Chapter 7. Rectangles. Rectangles are continuation patterns that form when price moves sideways between a clearly defined support and resistance level. Thomas Bulkowski explains that they are among the simplest and most visual patterns, yet highly effective for predicting trend continuation. Unlike triangles, pennants, or flags, rectangles represent a period of indecision where buyers and sellers are evenly matched, causing price to bounce back and forth within a horizontal channel. A rectangle begins after a strong trend, either upward or downward. Price reaches a level where it repeatedly meets resistance and support, creating a rectangular range. Each bounce between these levels represents traders testing the market, with neither side able to dominate immediately. The pattern continues until one side finally wins, causing a breakout in the direction of the prior trend. Volume is essential in rectangles. Bulkowski explains that during the sideways movement, volume often diminishes as the trading range tightens, reflecting reduced participation and temporary indecision. When the breakout occurs, volume usually surges, confirming the continuation of the trend. A breakout without increased volume may indicate a false signal, making careful observation critical. Rectangles can be bullish or bearish depending on the preceding trend. In an uptrend, a bullish rectangle forms after a strong move higher, indicating a temporary pause before buyers regain control. In a downtrend, a bearish rectangle appears after a steep decline, showing hesitation before sellers push the price lower again. Recognizing the context of the prior trend is crucial for interpreting rectangles accurately. Bulkowski emphasizes that rectangles provide clear entry and exit opportunities. Traders often enter a position just beyond the rectangle's boundary after confirmation of a breakout. Stop-loss orders are typically placed inside the rectangle on the opposite side of the breakout to minimize risk. The height of the rectangle can be used to estimate a potential price target by projecting it from the breakout point. This method gives traders a measurable and logical approach to managing trades. One of the advantages of rectangles is their clarity. Unlike more complex patterns, rectangles are easy to spot on charts, even for beginners. The well-defined support and resistance levels create visible zones where price is likely to react. By observing how price behaves near these boundaries, traders gain insight into market psychology, such as the strength of buyers or sellers. Rectangles also teach patience. The pattern represents a period of balance, and traders must wait for the breakout rather than forcing a trade. Entering too early within the rectangle increases the risk of losses if the market reverses unexpectedly. Discipline and timing are therefore critical for successfully trading rectangles. Bulkowski also points out that rectangles can fail. A breakout in the wrong direction or a quick reversal after an initial move can trap impatient traders. To reduce risk, it is important to confirm breakouts with volume and ensure the trend context supports the expected continuation. By mastering rectangles, traders add another powerful tool for identifying continuation patterns. They learn to interpret sideways price movement as a buildup of pressure rather than randomness. Rectangles reveal the tug-of-war between buyers and sellers and highlight the moments when one side finally asserts control. With rectangles understood, traders are now ready to study gaps, the final continuation pattern in this part. Gaps occur when price jumps above or below a previous range with little or no trading, signaling strong momentum and providing high probability opportunities for continuation trades. Chapter 8. Gaps. Gaps are unique continuation patterns that occur when price jumps above or below a previous trading range, with little or no trading in between. Thomas Bulkowski explains that gaps are powerful signals because they show sudden shifts in supply and demand, often driven by news, earnings, or market sentiment. Unlike triangles, flags, or rectangles, gaps are instantaneous, creating empty spaces on the chart that can signal strong momentum in the direction of the trend. There are four main types of gaps: common, breakaway, runaway, and exhaustion. Common gaps are small gaps that occur in normal trading and often get filled quickly, meaning price returns to the previous level. Breakaway gaps appear at the beginning of a new trend or after a consolidation period, signaling the start of strong movement. Runaway gaps occur during a trend and indicate accelerating momentum in the existing direction. Exhaustion gaps appear near the end of a trend and may signal that the move is about to reverse. Bulkowski emphasizes that identifying the type of gap is crucial for interpreting its meaning and predicting price action. Volume is a key factor in confirming gaps. Breakaway and runaway gaps are usually accompanied by high volume, showing strong participation from traders. Low volume on a gap may indicate weakness and increase the likelihood that the gap will fill quickly, reducing its significance. Understanding volume patterns in conjunction with gaps helps traders distinguish between genuine continuation signals and short-lived anomalies. Gaps provide both opportunities and challenges. A gap in the direction of the trend offers a chance to enter a strong move early, capturing momentum before the majority of traders notice. However, gaps can also mislead if misinterpreted, especially common gaps that fill quickly. Bulkowski advises waiting for confirmation, such as a continuation of price in the direction of the gap, or a retest of the gap area before committing to a trade. The psychology behind gaps is straightforward. They reflect sudden changes in sentiment. A breakaway gap shows that traders are ready to push price decisively, leaving previous resistance or support far behind. A runaway gap reveals confidence in the ongoing trend, with buyers or sellers unwilling to pause. An exhaustion gap signals a final burst of energy from one side before the market potentially reverses. Recognizing these emotions helps traders align with the flow of the market instead of fighting against it. Bulkowski also provides guidelines for measuring gaps. The height of the preceding price move or consolidation can be used to estimate potential targets for continuation gaps. Breakaway and runaway gaps, in particular, often project moves equal to or greater than the initial jump, offering measurable opportunities for profit. Stop losses should be placed strategically below or above the gap, depending on the trend direction, to manage risk effectively. Gaps also highlight the importance of context. A gap within a strong trend is more reliable than one appearing after a weak or choppy move. Market conditions, such as volatility, news events, and overall trend strength, affect the reliability of gap patterns. By combining trend analysis, volume, and gap type, traders can increase the probability of success. Understanding gaps completes the set of major continuation patterns. Traders who master triangles, pennants, flags, rectangles, and gaps gain the ability to identify where trends are likely to continue and position themselves strategically. The knowledge of these patterns builds confidence in trend-following strategies and helps avoid false moves. With continuation patterns fully covered, the book now shifts focus to patterns that signal a potential change in trend. Part 3. Reversal patterns. After mastering continuation patterns, the natural next step is to understand reversal patterns. While continuation patterns help traders ride trends, reversal patterns warn that a trend may be ending, and a new one is about to begin. Thomas Bulkowski explains that these patterns are critical for spotting opportunities to exit existing trades, enter new positions, or protect capital from sudden reversals. Reversal patterns form when the balance between buyers and sellers shifts. In an uptrend, a reversal pattern signals that sellers are gaining strength, and a downward move may follow. In a downtrend, it shows that buyers are starting to dominate, potentially pushing prices higher. Recognizing these shifts early gives traders a significant edge, allowing them to act before the market fully changes direction. Bulkowski emphasizes that reversal patterns are not magic, they are probabilistic. Each pattern has a statistical likelihood of success based on historical data. By studying thousands of examples, he identified which patterns are most reliable, how volume confirms them, and what warning signs indicate potential failure. This research-based approach distinguishes professional traders from those who rely on guesswork. Reversal patterns come in many shapes and sizes. Some are simple, like double tops and bottoms, which show clear tests of support or resistance. Others are more complex, like head and shoulders or diamond patterns, which reflect extended battles between buyers and sellers. Some patterns, like rounding tops and bottoms, form slowly and quietly, requiring careful observation and patience. Volume plays a crucial role in confirming reversals. For example, a head and shoulders pattern is far more reliable if volume decreases on the middle peak and increases when the neckline breaks. Ignoring volume can lead to false signals and unnecessary losses. Bulkowski stresses that the combination of price shape, trend context, and volume confirmation is what makes reversal patterns actionable. Understanding reversal patterns also deepens a trader's knowledge of market psychology. Each reversal reflects human behavior: fear, greed, hesitation, and capitulation. By studying these patterns, traders learn to anticipate shifts in sentiment, read the intentions of other participants, and position themselves strategically. This part of the book covers the most important reversal patterns, including head and shoulders, inverted head and shoulders, double and triple tops and bottoms, rounding formations, diamond patterns, and broadening formations. Each chapter breaks down the structure, psychology, volume signals, probability of success, and ways to measure potential price targets. Mastering reversal patterns is essential for any serious trader. They not only help in identifying trend changes, but also complement continuation patterns by showing when it is time to exit or reduce risk. With this knowledge, traders can navigate markets with confidence, spotting both the continuation and the end of trends. The next chapter, Head and Shoulders, introduces the first and most famous reversal pattern. It demonstrates the battle between buyers and sellers at the peak of an uptrend, providing clear visual cues for when the market may be about to change direction. Chapter 9. Head and Shoulders. The Head and Shoulders pattern is one of the most famous and reliable reversal patterns in technical analysis. Thomas Bulkowski explains that it signals a shift from an uptrend to a downtrend and is widely recognized by traders worldwide. It visually represents the struggle between buyers and sellers, showing when buying momentum is fading and selling pressure is taking control. The pattern has 3 peaks, a higher middle peak called the head and 2 lower peaks on either side called the shoulders. The line connecting the lows between the peaks is called the neckline. When price breaks below the neckline after forming the right shoulder, it confirms that the trend has reversed. The magnitude of the expected decline can be estimated by measuring the distance from the head to the neckline and projecting it downward from the breakout point. Volume plays a key role in confirming a head and shoulders pattern. During the formation of the left shoulder, volume is usually high, reflecting the strength of the prevailing uptrend. Volume often decreases on the head and drops further on the right shoulder, showing weakening buying pressure. A surge in volume when the price breaks the neckline confirms that sellers have taken control, validating the reversal. Bulkowski emphasizes that the head and shoulders pattern is not perfect. Sometimes the right shoulder may be slightly higher or lower than the left, or the neckline may slope up or down. Traders should focus on the overall structure and confirmation of the breakout rather than expecting a textbook formation. Patience is crucial. Entering too early can lead to false signals and losses. The pattern can also form in reverse, called an inverted head and shoulders, signaling the end of a downtrend and the start of an uptrend. The inverted version has the same 3-peak structure, but upside down, with the middle trough as the head and 2 higher troughs as shoulders. Breakouts above the neckline in this pattern confirm that buyers are gaining control. Both regular and inverted patterns provide high probability opportunities if confirmed with volume and trend context. Psychologically, the head and shoulders pattern reflects the changing balance of power in the market. The left shoulder shows a strong push by buyers, the head represents the last surge of enthusiasm, and the right shoulder demonstrates hesitation and the rise of selling pressure. By interpreting this shift, traders gain insight into market sentiment and can position themselves ahead of major reversals. Bulkowski also provides statistical data on head and shoulders reliability. Historically, this pattern has a high probability of success, particularly when it occurs after a long uptrend with significant volume. However, he warns that patterns in choppy or sideways markets are less reliable and require additional confirmation. Traders often use the head and shoulders pattern to set both entry and exit points. A conservative approach is to wait for the price to break the neckline and close beyond it with volume confirmation before entering a trade. Stop-loss orders are usually placed above the right shoulder to limit risk in case of false breakouts. Price targets are measured from the head to the neckline and projected downward, providing a logical framework for managing the trade. By mastering the head and shoulders pattern, traders gain one of the most powerful tools for spotting trend reversals. It combines visual clarity, psychological insight, and statistical reliability, making it a cornerstone of technical analysis. Once this pattern is understood, traders are ready to explore its mirror image, the inverted head and shoulders, which signals a potential shift from a downtrend to an uptrend and opens opportunities for bullish trades. Chapter 10. Inverted head and shoulders. The inverted head and shoulders pattern is the mirror image of the classic head and shoulders, signaling the potential end of a downtrend and the beginning of an uptrend. Thomas Bulkowski explains that this pattern is a powerful reversal indicator, providing traders with opportunities to enter the market at the early stages of a bullish move. Just like its regular counterpart, it reflects the psychological battle between buyers and sellers, but in this case, buyers are gaining control. The structure consists of 3 troughs. The middle trough, the head, is the lowest point, flanked by 2 higher troughs called the shoulders. The line connecting the highs between the troughs is called the neckline. When price breaks above the neckline, it confirms that buyers have overpowered sellers, and the downtrend is likely over. The projected price move is estimated by measuring the distance from the head to the neckline and adding it to the breakout point. Volume is critical in confirming the pattern. During the formation of the left shoulder, volume may be high as sellers still dominate. On the head, volume often decreases, indicating that selling pressure is weakening. When the right shoulder forms, volume may remain low until the breakout occurs. A surge in volume as price moves above the neckline confirms that buyers are in control, validating the reversal. Bulkowski points out that inverted head and shoulders patterns are not always perfect. The shoulders may be slightly uneven, or the neckline may slope upward or downward. Traders should focus on the overall structure and confirmation, rather than a textbook shape. Premature entries before the breakout can lead to losses, so patience and discipline are key. Psychologically, the pattern illustrates a shift in market sentiment. The left shoulder represents a final attempt by sellers to push price lower. The head shows the last strong decline, often followed by hesitation. The right shoulder demonstrates that selling pressure is fading, and buyers are gradually gaining strength. By observing this progression, traders can anticipate the trend reversal and position themselves advantageously. The pattern is particularly reliable when it occurs after a prolonged downtrend with heavy volume. Bulkowski's research indicates that breakouts in these contexts have a high probability of leading to significant upward moves. However, patterns appearing in choppy or sideways markets may be less reliable and require additional confirmation. Traders use the inverted head and shoulders pattern to plan entries, exits, and risk management. A conservative entry occurs after the price closes above the neckline with increased volume. Stop-loss orders are typically placed below the right shoulder to protect against false breakouts. Price targets are measured from the head to the neckline and projected upward, giving a clear and logical framework for managing trades. Inverted head and shoulders patterns are essential tools for spotting bullish reversals. They combine structural clarity, psychological insight, and statistical reliability, providing traders with confidence when entering a new uptrend. Once this pattern is understood, traders can move on to double tops and bottoms, which signal trend reversals through repeated tests of key support and resistance levels and are equally valuable for predicting changes in market direction. Chapter 11. Double tops and bottoms. Double tops and bottoms are classic reversal patterns that signal the potential end of a trend through repeated tests of key price levels. Thomas Bulkowski explains that these patterns are easy to recognize and highly effective for identifying trend reversals. They reflect the market's struggle between buyers and sellers, showing when one side is losing momentum and a change in direction is likely. A double top forms after an uptrend. Price rises to a peak, then declines to a support level, and attempts to rise again, but fails to surpass the previous high. The two peaks create the double top shape, with the support level forming a neckline. When price breaks below the neckline after the second peak, it confirms that sellers have taken control, and a downtrend is likely to follow. The expected price decline can be estimated by measuring the distance from the peaks to the neckline and projecting it downward from the breakout point. Conversely, a double bottom forms after a downtrend. Price falls to a low, rebounds to a resistance level, and declines again, but fails to reach a new low. The two troughs create the double bottom shape, with the resistance level acting as the neckline. A breakout above the neckline confirms that buyers are gaining strength and an uptrend may begin. The projected price target is measured from the neckline to the low of the trough and added to the breakout point. Volume is crucial in confirming these patterns. In a double top, volume is typically higher during the first peak and weaker during the second, showing that buying pressure is fading. A surge in volume as price breaks below the neckline validates the reversal and increases the probability of a strong downward move. In a double bottom, volume is often high during the first low, declines during the second, and increases on the breakout above the neckline, confirming the upward reversal. Bulkowski emphasizes that double tops and bottoms are not always perfect. The peaks or troughs may be slightly uneven, and the neckline may slope up or down. Traders should focus on the overall pattern and confirmation rather than expecting textbook precision. Patience is key. Entering too early or ignoring volume signals can lead to false breakouts and losses. These patterns are psychologically intuitive. A double top reflects that buyers tried twice to push prices higher, but failed, indicating weakening demand and rising selling pressure. A double bottom shows that sellers attempted to push prices lower twice, but could not, signaling diminishing supply and increasing buyer strength. Recognizing these shifts allows traders to anticipate market movements and act strategically. Double tops and bottoms provide clear guidance for entries, exits, and risk management. Conservative traders wait for a confirmed breakout of the neckline with strong volume before entering a trade. Stop-loss orders are typically placed beyond the most recent peak or trough to protect against false signals. Price targets are estimated using the height of the pattern, giving a structured approach to profit-taking. Bulkowski also notes that these patterns can appear in both short-term and long-term charts, making them versatile tools for day traders, swing traders, and long-term investors. They are often combined with other technical indicators, such as moving averages or momentum oscillators, to improve accuracy. By mastering double tops and bottoms, traders gain insight into repeated market tests of supply and demand. These patterns reveal when a trend is weakening and when a reversal is likely, offering high probability opportunities. With this understanding, the next logical step is triple tops and bottoms, which are similar but involve 3 attempts at breaking key levels, providing additional confirmation of a potential trend change. Chapter 12. Triple tops and bottoms. Triple tops and bottoms are extensions of the double top and bottom patterns, providing stronger confirmation of potential trend reversals. Thomas Bulkowski explains that these patterns form when price tests the same support or resistance level 3 times without breaking through, signaling that the market is struggling to continue in the previous trend direction. They are less common than double tops and bottoms, but their reliability is generally higher due to the repeated tests of key levels. A triple top forms after an uptrend. Price rises to a peak, falls to a support level, rises again to the same peak, declines again, and attempts a third rise but fails once more. The 3 peaks create the triple top formation, with the support level forming a neckline. When price finally breaks below the neckline after the 3rd peak, it confirms that sellers have taken control, and a downtrend is likely to begin. The expected price move is estimated by measuring the distance from the peaks to the neckline and projecting it downward from the breakout. A triple bottom forms after a downtrend. Price falls to a low, rebounds to a resistance level, drops again to the same low, rises again, and makes a 3rd attempt to break lower but fails. The 3 troughs form the triple bottom pattern, with the resistance acting as the neckline. A breakout above the neckline confirms that buyers have gained strength, signaling a potential uptrend. The price target is measured from the resistance to the lowest trough and added to the breakout point. Volume is essential for confirming triple tops and bottoms. In a triple top, volume is typically highest on the first peak and gradually decreases on the second and third, showing weakening buying interest. A surge in volume when price breaks the neckline validates the reversal and increases confidence in a downward move. For a triple bottom, volume is high during the first trough, diminishes during the subsequent tests, and increases on the breakout above the neckline, confirming the upward reversal. Bulkowski notes that triple tops and bottoms are psychologically intuitive. In a triple top, buyers try 3 times to push prices higher but fail each time, signaling exhaustion and rising seller dominance. In a triple bottom, sellers fail repeatedly to drive prices lower, reflecting weakening supply and growing buyer strength. These repeated failures help traders anticipate the shift in market sentiment and prepare for the new trend. Triple tops and bottoms provide clear guidelines for entry, exit, and risk management. Conservative traders wait for the breakout of the neckline with volume confirmation before entering a position. Stop-loss orders are placed just beyond the most recent peak or trough to protect against false breakouts. Price targets are estimated using the height of the pattern, offering a structured approach to managing trades. Bulkowski also emphasizes that triple tops and bottoms are versatile across time frames. They appear in intraday, daily, weekly, and even monthly charts, allowing both short-term traders and long-term investors to use them effectively. Combining them with other technical tools, like moving averages, trend lines, or momentum indicators, can enhance their predictive power. By mastering triple tops and bottoms, traders gain a deeper understanding of how repeated market tests of supply and demand indicate trend exhaustion. These patterns confirm potential reversals more strongly than double tops or bottoms, providing higher probability trading opportunities. With this knowledge, traders are ready to move on to rounding tops and bottoms, which are slower, smoother reversals that reflect gradual shifts in market sentiment over longer periods. Chapter 13. Rounding tops and bottoms. Rounding tops and bottoms are gradual reversal patterns that indicate a slow shift in market sentiment. Thomas Bulkowski explains that these patterns form over longer periods and are less sharp than other reversal formations like head and shoulders or double tops. They are ideal for understanding trends that evolve gradually rather than through sudden price movements, reflecting the steady change of power between buyers and sellers. A rounding top forms after an uptrend. Price rises to a peak, then slowly levels off and begins to decline in a curved, bowl-like shape. This pattern signals that buying momentum is fading and selling pressure is gradually increasing. The point where the price breaks below the support level at the base of the curve confirms the reversal and indicates that a downtrend may be starting. The expected price decline can be measured by projecting the height of the curve downward from the breakout point, giving traders a realistic target. A rounding bottom, conversely, forms after a downtrend. Price falls to a low, gradually flattens, and then begins a slow upward curve. This shape reflects the waning influence of sellers and the growing dominance of buyers. A breakout above the resistance level at the top of the curve confirms that an uptrend may begin, signaling a shift in control to the buyers. Price targets are estimated by projecting the height of the curve upward from the breakout point. Volume is critical in rounding patterns. In a rounding top, volume is often high during the initial uptrend, decreases as the curve forms, and may rise again as price breaks below support, confirming the reversal. In a rounding bottom, volume is high during the initial decline, decreases during the flat part of the curve, and surges as price breaks above resistance, validating the new uptrend. Monitoring volume helps traders distinguish between genuine reversals and temporary pauses in the trend. Bulkowski emphasizes the psychological aspect of rounding patterns. A rounding top reflects cautious selling and fading enthusiasm among buyers over time, rather than panic selling. A rounding bottom shows hesitation among sellers and increasing confidence among buyers, resulting in a gradual shift of power. By recognizing this slow change, traders can position themselves early for a significant trend reversal. Rounding tops and bottoms require patience. Because they form over longer periods, premature entries can lead to losses if the breakout does not occur as expected. Traders are advised to wait for confirmation through a close beyond the support or resistance level, ideally accompanied by increased volume. Stop-loss orders should be placed strategically to protect against false breakouts. These patterns are versatile across time frames. They can appear in daily, weekly, and monthly charts, making them suitable for swing traders, position traders, and long-term investors. Their smooth, rounded shape makes them visually distinct and relatively easy to identify once familiar with the pattern's characteristics. Bulkowski also notes that rounding patterns can provide strong price targets and risk management guidelines. By measuring the depth of the curve, traders can project the potential move and calculate favorable risk-to-reward ratios. This combination of visual clarity, statistical reliability, and psychological insight makes rounding tops and bottoms valuable tools for trend reversal analysis. With rounding patterns understood, traders are prepared to explore diamond patterns, The next reversal formation. Diamonds are more complex in structure and reflect a high level of market indecision before a significant trend reversal occurs, making them a critical pattern for advanced traders. Chapter 14. Diamond Patterns. Diamond patterns are complex reversal formations that signal major shifts in market trends. Thomas Bulkowski explains that diamonds typically form after a strong uptrend or downtrend and represent a period of intense indecision between buyers and sellers. Their distinctive shape, wide at the start, narrowing in the middle, and widening again, makes them visually striking and highly valuable for traders who recognize them. A diamond top forms after an uptrend. Price initially moves upward, creating a broad range, then starts to fluctuate with higher highs and lower lows, forming the left half of the diamond. As the pattern progresses, the swings narrow, creating the middle section of the diamond, reflecting uncertainty and a struggle between buyers and sellers. The right half of the diamond expands again before price eventually breaks down, signaling that sellers have gained control and a downtrend is likely. The projected decline can be measured by calculating the height of the diamond at its widest point and projecting it from the breakout. A diamond bottom, forming after a downtrend, is the mirror image. Price initially falls, forming a wide range, then fluctuates with lower lows and higher highs, creating the left half of the diamond. The middle narrows as indecision peaks, and finally the right half widens before price breaks upward, confirming a bullish reversal. The height of the diamond is projected upward from the breakout point to estimate the potential move. Volume is critical in diamond patterns. Bulkowski notes that volume is usually high at the start, decreases as the diamond narrows, and then spikes during the breakout. A breakout with weak volume may be unreliable, while strong volume confirms that the market has chosen a direction. Traders should always look for volume confirmation before acting on a diamond pattern. The psychology behind diamonds reflects a tug-of-war between market participants. In a diamond top, buyers attempt to push prices higher, but are increasingly countered by sellers, creating wider swings. As indecision peaks, neither side dominates until sellers finally take control. In a diamond bottom, sellers struggle to drive prices lower, buyers gradually gain confidence, and the eventual breakout signals a new uptrend. Recognizing this battle allows traders to anticipate the eventual direction and position themselves advantageously. Bulkowski emphasizes that diamonds are relatively rare but highly reliable. Because they involve multiple swings and require careful observation, they are often missed by less experienced traders. Patience is essential. Entering too early before the breakout can result in losses, while waiting for confirmation increases the probability of a successful trade. Traders use diamond patterns to set entries, exits, and stop-loss levels strategically. Entry points are usually placed just beyond the breakout boundary, with stop-loss orders inside the pattern to protect against false signals. Price targets are measured using the height of the diamond, providing a structured approach for risk and reward management. Diamond patterns also highlight the importance of context. A diamond forming after a strong trend is more likely to produce a meaningful reversal than one appearing in a choppy market. Combining the diamond with other technical indicators, such as moving averages or momentum oscillators, can further enhance its predictive power. By mastering diamond patterns, traders gain insight into complex market psychology and high-probability reversals. These patterns reveal moments when the struggle between buyers and sellers reaches its peak, signaling a significant shift in control. With diamonds understood, the next chapter, Broadening Formations, explores another reversal pattern that indicates increasing volatility and expanding swings, offering traders a unique way to anticipate trend changes. Chapter 15. Broadening Formations. Broadening formations, also called megaphone patterns, are reversal patterns that indicate increasing volatility and uncertainty in the market. Thomas Bulkowski explains that these patterns form when price swings become progressively wider, showing a battle between buyers and sellers that grows more intense over time. Unlike other reversal patterns, broadening formations signal expanding market activity rather than consolidation, giving traders insight into potential trend changes. A broadening top forms after an uptrend. Price initially reaches a high, then retraces, followed by a higher peak, a lower trough, and finally another higher peak. Each successive high and low is more extreme than the previous, creating a megaphone shape. This pattern reflects the struggle between buyers attempting to push price higher and sellers increasingly resisting the trend. When price eventually breaks below the lowest trough, it confirms that sellers have taken control, and a downtrend is likely to follow. The projected decline can be estimated by measuring the height from the first peak to the lowest trough and projecting it downward from the breakout point. A broadening bottom forms after a downtrend. Price falls to a low, rebounds, forms a lower low, then a higher high, and finally another lower low. The swings expand progressively, forming the megaphone shape upside down. A breakout above the highest peak confirms that buyers are gaining control, signaling a potential uptrend. Price targets are measured from the highest peak to the lowest trough and added to the breakout point. Volume plays a significant role in broadening formations. During the initial swings, volume is moderate, reflecting normal market activity. As the pattern develops, volume often increases on each successive move, indicating growing participation and volatility. A breakout accompanied by high volume confirms the trend reversal, while weak volume may indicate a false signal. The psychology behind broadening formations is straightforward. In a broadening top, buyers become increasingly aggressive, trying to push prices higher, but sellers resist more strongly with each attempt, resulting in expanding swings. In a broadening bottom, sellers grow more desperate to push prices lower, while buyers gain confidence, causing price swings to widen in the opposite direction. Recognizing this battle allows traders to anticipate the eventual winner and position themselves strategically. Bulkowski notes that broadening formations are relatively rare but highly informative. They often occur at market tops or bottoms, providing early warnings of trend exhaustion. Patience is key. Entering too early within the formation can lead to losses due to the erratic swings. Traders should wait for a confirmed breakout in the direction of the reversal before taking a position. Traders use broadening formations to plan entries, exits, and risk management. Entry points are placed just beyond the breakout boundary, with stop-loss orders set inside the formation to protect against false moves. Price targets are measured using the height of the formation, giving a logical approach to managing trades. Understanding broadening formations adds another dimension to reversal pattern analysis. These patterns highlight growing market volatility and the shifting balance between buyers and sellers, signaling potential trend changes before they occur. With broadening formations mastered, traders are now ready to move into Part 4, Candlestick Patterns, which focuses on short-term patterns formed by candlestick charts and provides insights into immediate market sentiment and potential reversals. Part 4. Candlestick Patterns. After studying continuation and reversal patterns, the next step is to focus on candlestick patterns, a visual and highly practical tool for understanding short-term market behavior. Thomas Bulkowski explains that candlestick charts condense price action into single bars, showing the open, high, low, and close of a trading period. These charts make it easier to read market sentiment and spot potential reversals or continuation signals at a glance. Candlestick patterns are built from one or more candles. Single candle patterns, like dojis or hammers, can indicate indecision or a potential reversal. Two candle patterns, such as engulfing patterns, reveal shifts in momentum. Three candle and multiple candle formations provide even stronger signals, showing the interaction between buyers and sellers over consecutive periods. Bulkowski emphasizes that understanding the structure and psychology behind these patterns is essential for successful trading. Volume, trend context, and confirmation remain key even in candlestick analysis. A bullish engulfing pattern in an uptrend may be less significant than the same pattern after a prolonged downtrend. Similarly, candlestick patterns are most reliable when accompanied by confirming volume or trend signals, reducing the likelihood of false interpretations. Candlestick patterns are not just about spotting reversals. They can also confirm the continuation of a trend. For example, a series of long bullish candles during an uptrend indicates that buyers remain in control, while long bearish candles in a downtrend confirm continued selling pressure. By combining candlestick analysis with the patterns learned in previous parts, traders gain a more complete picture of market behavior. This part of the book is divided into 4 chapters. Single candle patterns focus on the simplest formations and their psychological implications. 2. Candle patterns explore how consecutive candles reveal shifts in control between buyers and sellers. 3 candle patterns examine stronger reversal or continuation signals formed over multiple periods. Multiple candle patterns cover complex formations that capture extended interactions in the market, providing higher probability trading opportunities. Mastering candlestick patterns allows traders to react more quickly to market changes, enter trades with better timing, and manage risk more effectively. These patterns bridge the gap between the longer-term chart formations and the immediate price action, offering insights that are both visual and statistically reliable. The next chapter, Single Candle Patterns, introduces the first layer of candlestick analysis. It examines individual candles, their shapes, and what they reveal about market sentiment, forming the foundation for understanding more complex multi-candle formations in subsequent chapters. Chapter 16. Single Candle Patterns. Single candle patterns are the most basic form of candlestick analysis, yet they provide valuable insights into market sentiment and potential price movements. Thomas Bulkowski explains that each candle represents a trading period, showing the open, high, low, and close. The shape, size, and position of a single candle can reveal whether buyers or sellers are in control, and whether a reversal or continuation is likely. One of the most important single candle patterns is the doji. A doji forms when the opening and closing prices are very close or equal, creating a small body with long or short wicks. This indicates indecision in the market. Neither buyers nor sellers dominate. In an uptrend, a doji may signal that buyers are losing strength, suggesting a potential reversal. In a downtrend, it may indicate that selling pressure is fading and buyers could gain control. Volume confirmation and the trend context are essential for interpreting dojis accurately. Another key pattern is the hammer. A hammer forms during a downtrend, with a small body near the top of the candle and a long lower wick. It shows that sellers tried to push the price lower, but buyers regained control and closed near the opening price. This signals potential bullish reversal, especially when it appears near a support level and is confirmed by higher volume. The hanging man is the bearish counterpart of the hammer. It forms in an uptrend with a small body near the top and a long lower wick. This indicates that buyers may be losing control and sellers are starting to exert influence. A hanging man followed by a decline in price confirms the potential for a reversal. Bulkowski also highlights the spinning top, a candle with a small body and wicks on both sides. It reflects uncertainty and indecision, often signaling a pause in the current trend. The spinning top itself does not guarantee a reversal, but it alerts traders to a possible change in sentiment. Confirmation through the next candle or additional indicators is necessary before acting. Volume is a critical factor in interpreting single candle patterns. A hammer or doji with high volume is more significant than one with low volume, as it reflects stronger participation and conviction in the market. Traders often combine single candle analysis with support, resistance, and other technical patterns to improve the probability of success. Single candle patterns are also valuable because they can appear in any time frame. They can be used on intraday charts for day trading, daily charts for swing trading, or weekly charts for long-term investing. Their versatility allows traders to respond to immediate price action while considering the broader market context. Psychologically, single candle patterns reveal the ongoing battle between buyers and sellers. A hammer shows buyers fighting back after selling pressure, while a hanging man shows sellers starting to influence the market after a bullish run. Recognizing these subtle shifts provides early warning of potential reversals and helps traders make informed decisions. Mastering single candle patterns lays the foundation for understanding more complex formations. Once traders can read the sentiment behind a single candle, they are ready to explore 2 candle patterns, where consecutive candles interact to provide stronger reversal or continuation signals. These multi-candle formations increase reliability and offer higher probability trading opportunities. Chapter 17. 2 Candle Patterns. Two-candle patterns provide stronger signals than single-candle formations by analyzing the interaction between consecutive trading periods. Thomas Bulkowski explains that these patterns capture shifts in momentum, showing how buyers and sellers react to each other over time. By studying two-candle patterns, traders can gain early insights into potential reversals or continuations, increasing the probability of successful trades. One of the most important two-candle patterns is the bullish engulfing. It forms when a small bearish candle is followed by a larger bullish candle that completely engulfs the previous candle's body. This indicates that buyers have taken control, overpowering the sellers from the prior period. Bullish engulfing patterns appearing after a downtrend are strong reversal signals, especially when confirmed by rising volume and key support levels. Conversely, the bearish engulfing pattern signals a potential downtrend. A small bullish candle is followed by a larger bearish candle that engulfs the prior body, showing that sellers have gained dominance. This pattern is most reliable at the top of an uptrend or near resistance, confirmed by increased selling volume. Another key two-candle pattern is the piercing line, which occurs after a downtrend. The first candle is bearish, followed by a bullish candle that opens lower but closes above the midpoint of the previous candle. This demonstrates that buyers are stepping in aggressively, potentially reversing the trend. The bullish counterpart, called the dark cloud cover, appears after an uptrend, where a bearish candle closes below the midpoint of the preceding bullish candle, signaling that sellers are gaining strength. Volume confirmation remains essential in two-candle patterns. A bullish engulfing pattern with weak volume may not be reliable, while one with high volume indicates strong buying pressure. Similarly, a bearish engulfing pattern is more credible when accompanied by increased selling activity. By combining volume analysis with trend context, traders improve the accuracy of their signals. The psychology behind two-candle patterns is clear. A bullish engulfing pattern reflects the shift in control from sellers to buyers, showing that the market sentiment is changing. A bearish engulfing or dark cloud cover indicates that sellers are overcoming buyer enthusiasm, suggesting an imminent downtrend. By recognizing these dynamics, traders can anticipate trend changes earlier than relying solely on single candle signals. Two-candle patterns are also versatile across time frames. They can be used for intraday trading, swing trading, or even long-term position trading, depending on the chart period being analyzed. They provide flexibility for traders who need timely entry signals while considering the broader market trend. Bulkowski emphasizes that while two-candle patterns are more reliable than single-candle formations, confirmation is still crucial. Waiting for additional price action, volume signals, or alignment with support and resistance levels reduces the risk of false signals. Mastering two-candle patterns prepares traders for more complex formations. Once the interaction between two candles is understood, it becomes easier to interpret three-candle patterns, where multiple periods combine to provide even stronger reversal or continuation signals. These patterns reveal deeper market sentiment and allow traders to make more informed and confident decisions. Chapter 18. Three-candle patterns. Three-candle patterns build on the principles of single and two-candle formations, providing even stronger signals by analyzing price action over 3 consecutive periods. Thomas Bulkowski explains that these patterns offer a clearer picture of market psychology, showing how buyers and sellers interact over time, and increasing the reliability of potential reversal or continuation signals. One of the most widely recognized three-candle patterns is the morning star. It appears after a downtrend and signals a potential bullish reversal. The first candle is bearish, showing continued selling pressure. The second candle is small and may be bullish or bearish, representing indecision as the downtrend begins to lose momentum. The third candle is a strong bullish candle that closes above the midpoint of the first, confirming that buyers are taking control and signaling a reversal. Volume confirmation enhances the pattern's reliability. The evening stare is the bearish counterpart, forming after an uptrend. The first candle is bullish, reflecting strong buying. The second candle is small, showing hesitation or indecision among traders. The third candle is a strong bearish candle that closes below the midpoint of the first, confirming that sellers have gained control and a potential downtrend may follow. This pattern effectively captures the shift in market sentiment from buyers to sellers. Another important three-candle pattern is the three white soldiers. It consists of three consecutive long bullish candles with small or no wicks, each closing progressively higher. This pattern indicates strong, sustained buying and the likely continuation of an uptrend. Conversely, the three black crows pattern consists of three consecutive long bearish candles with small bodies, signaling strong selling and the continuation of a downtrend. Three-candle patterns are valuable because they provide more confirmation than single or two-candle patterns. A single bullish candle may reflect temporary buying, and a two-candle pattern can sometimes be misleading. By analyzing three candles, traders gain additional clarity, making these patterns more reliable for identifying trend changes or continuations. Volume is a key factor in three-candle patterns. In the morning star, increased volume on the third candle confirms that buyers are entering the market with conviction. In the evening star, higher volume on the third candle signals strong selling pressure. Similarly, three white soldiers and three black crows are more trustworthy when accompanied by significant volume, reflecting widespread participation in the trend. The psychology behind three-candle patterns is intuitive. Morning and evening stars reflect the market's hesitation, followed by decisive action in the opposite direction. Three white soldiers and three black crows show sustained control by buyers or sellers, demonstrating market confidence in the trend's continuation. By interpreting these patterns, traders gain insight into sentiment shifts and can make informed decisions. Bulkowski emphasizes that three-candle patterns are versatile and can be applied across time frames. They appear in intraday, daily, weekly, and even monthly charts, making them useful for day traders, swing traders, and long-term investors alike. Combining three-candle patterns with other technical tools, such as support, resistance, and moving averages, further improves accuracy. Mastering three-candle patterns prepares traders for multiple candle patterns, the next chapter. These involve more complex formations over several periods, capturing extended interactions between buyers and sellers, providing higher probability signals, and offering advanced insights into market behavior. Chapter 19. Multiple Candle Patterns. Multiple candle patterns are the most advanced category of candlestick formations, involving sequences of 4 or more candles. Thomas Bulkowski explains that these patterns capture extended interactions between buyers and sellers, providing high probability signals of trend reversals or continuations. By analyzing multiple periods together, traders gain a comprehensive view of market psychology and momentum shifts that shorter patterns might miss. One of the most famous multiple candle patterns is the 3 inside up, which is an extension of the morning star. It begins with a long bearish candle, followed by a smaller bullish candle that stays within the body of the first. The third candle is a strong bullish candle that closes above the first candle's midpoint, confirming a reversal. Some variations may include additional bullish candles to strengthen the signal, showing sustained buying pressure. The 3 inside down is the bearish counterpart, signaling a potential downtrend. It begins with a long bullish candle, followed by a smaller bearish candle within the first candle's body. The third candle is a strong bearish candle that closes below the midpoint of the first, confirming seller's dominance. Additional bearish candles in the sequence increase the reliability of the pattern and indicate continued selling pressure. Other multiple candle patterns, such as 3 outside up and 3 outside down, involve 3 candles, where the second candle engulfs the first, and the third confirms the reversal. These patterns provide clearer confirmation than single or 2 candle formations, because they capture both hesitation and decisive market action over multiple periods. Volume remains a critical factor in multiple candle patterns. Patterns with low volume may indicate indecision or a weak signal, while patterns accompanied by high volume reflect strong participation and conviction. Bulkowski emphasizes that combining multiple candle patterns with trend context, support and resistance levels, and other technical indicators improves reliability. The psychology behind multiple candle patterns reflects an evolving battle between buyers and sellers. Initial candles often show hesitation or indecision, reflecting uncertainty in the market. Subsequent candles reveal the eventual winner, whether buyers gaining control for a bullish reversal or sellers taking charge for a bearish reversal. By understanding this gradual shift, traders can enter trades with greater confidence and accuracy. Multiple candle patterns are versatile across time frames. They can appear in intraday charts for day trading, daily charts for swing trading, and weekly or monthly charts for long-term analysis. Their ability to provide strong confirmation makes them particularly useful for traders seeking higher probability setups with defined risk and reward. Bulkowski provides guidance on practical application. Traders should wait for confirmation before acting, place stop-loss orders strategically, and use price targets based on pattern height or trend projections. Multiple candle patterns are best interpreted in the context of overall market conditions, combining them with previously studied continuation and reversal patterns for a holistic approach. Mastering multiple candle patterns completes the core of candlestick analysis. With this foundation, traders are ready to move into Part 5. Special topics, where Bulkowski explores advanced trading concepts such as measuring price targets, volume confirmation, pattern failures, and practical trading tips. These topics integrate the lessons from all previous parts, providing traders with the tools to apply chart pattern analysis effectively in real-world markets. Part 5. Special topics. After mastering continuation, reversal, and candlestick patterns, the next step is to explore special topics that enhance practical trading skills. Thomas Bulkowski explains that understanding chart patterns alone is not enough for consistent trading success. Traders must also learn how to measure price targets, confirm patterns with volume, identify potential failures, and apply rules for risk management and trade execution. This part focuses on advanced concepts that bridge theory and real-world application. Measuring price targets helps traders estimate potential gains from a breakout or reversal, allowing for informed entry and exit decisions. Volume confirmation ensures that patterns are backed by market participation, reducing the risk of false signals. Pattern failures are inevitable, and recognizing them early helps limit losses and improve decision-making. Finally, trading tips and guidelines consolidate Bulkowski's decades of research, providing practical strategies for applying chart patterns effectively. By studying these special topics, traders can move from simply recognizing patterns to executing trades with confidence and discipline. These lessons integrate all the knowledge gained from previous parts, giving a comprehensive framework for analyzing charts and managing risk. The next chapter, Measuring Price Targets, introduces techniques for projecting potential price moves after a pattern completes. It explains how to use the height of patterns, breakout points, and trend context to set realistic targets, forming the foundation for profitable trading strategies. Chapter 20, Measuring Price Targets. Measuring price targets is a critical skill for traders who want to translate chart patterns into actionable trades. Thomas Bulkowski explains that knowing where a price is likely to move after a breakout or reversal allows traders to plan entries, exits, and risk management effectively. Without price targets, trading becomes guesswork, relying on hope rather than a structured approach. For continuation patterns like triangles, pennants, and flags, the price target is often calculated by measuring the height of the pattern at its widest point. This height is then added to the breakout point in an uptrend, or subtracted from the breakout in a downtrend. This method provides a logical estimate of how far the price may move and helps set realistic profit objectives. For reversal patterns such as head and shoulders or double tops and bottoms, the height of the formation between the peak, or trough, and the neckline is used. When price breaks the neckline, the measured distance is projected in the direction of the breakout to establish a target. For example, a head and shoulders pattern with a head to neckline distance of 10 points suggests that the price may decline roughly 10 points after the neckline is broken. This measurement technique provides a structured, objective approach to trading reversals. Volume plays a supporting role in confirming that price targets are achievable. A breakout accompanied by strong volume indicates that the move is supported by market participation and increases the likelihood of reaching the projected target. Weak volume may suggest that the breakout is not genuine, warning traders to adjust expectations or avoid entering a trade. Bulkowski also highlights that pattern context is essential. Targets should be adjusted based on the prevailing trend, support and resistance levels, and the overall market environment. For example, if a price target extends into strong resistance, it may be unrealistic to expect the full move without hesitation. Similarly, targets in volatile markets may overshoot, requiring flexible trade management strategies. Psychologically, measuring price targets reduces uncertainty and emotional decision-making. Traders know where to expect profit and where to place stop-loss orders, which instills discipline and confidence. By projecting potential moves, traders can evaluate risk-to-reward ratios, ensuring that each trade aligns with their trading plan. Bulkowski provides practical tips for using price targets. Avoid relying solely on one method. Combine pattern height measurements with trend lines, support and resistance, and other technical tools. Adjust targets dynamically as the market progresses, especially if new patterns or candlestick signals emerge. Documenting and reviewing trades based on projected versus actual outcomes helps improve accuracy over time. Measuring price targets is not an exact science, but it provides a logical framework for trading decisions. It transforms chart patterns from theoretical shapes into actionable strategies that guide entries, exits, and position sizing. With this skill, traders can approach the market with a structured plan rather than reacting emotionally to price movements. The next chapter, Volume Confirmation, builds on this concept by explaining how to use volume to validate breakouts, reversals, and pattern reliability. Combining price targets with volume confirmation increases the probability of success and helps traders distinguish between genuine moves and false signals. Chapter 21. Volume Confirmation. Volume confirmation is one of the most important tools for validating chart patterns and price targets. Thomas Bulkowski explains that price movements alone can be misleading, but when paired with volume analysis, traders gain insight into the strength and reliability of a breakout or reversal. Volume reflects the number of shares or contracts traded, indicating the level of market participation and conviction behind a move. For continuation patterns like triangles, flags, and pennants, volume often contracts as the pattern develops. A breakout accompanied by a sudden surge in volume confirms that buyers or sellers are stepping in with strength, increasing the likelihood that the price will reach the projected target. Without volume confirmation, a breakout may fail or reverse quickly, leading to potential losses. In reversal patterns such as head and shoulders, double tops, or triple bottoms, volume plays a critical role in validating the change of trend. For example, a head and shoulders top is more reliable if volume is high during the formation of the left shoulder and head, but decreases during the right shoulder. The breakout below the neckline should then occur with increasing volume to confirm that sellers are taking control. Similarly, in double bottoms, higher volume on the breakout above the neckline strengthens the signal of a bullish reversal. Volume analysis also applies to candlestick patterns. In single candle formations, a hammer or hanging man with higher volume indicates stronger conviction and reliability. Two candle patterns like bullish or bearish engulfing are more significant when the second candle shows higher volume than the first. Three candle and multiple candle patterns are also confirmed by volume spikes, showing that the market supports the direction suggested by the pattern. Bulkowski emphasizes that traders should look for volume patterns in context. Volume that is high relative to previous periods indicates increased interest, while unusually low volume during a breakout may signal a false move. Additionally, trends with consistent volume are more stable, while erratic volume may indicate market uncertainty. Volume can also be used to anticipate pattern failures. For example, if a breakout occurs with weak volume and immediately reverses, it suggests that the breakout lacked participation and is likely to fail. Conversely, strong volume increases confidence that the breakout or reversal will succeed, allowing traders to plan entries and exits with more certainty. Psychologically, volume confirmation provides a measurable signal of market sentiment. It shows whether buyers or sellers are genuinely in control rather than relying on price alone, which can be influenced by short-term manipulations or low liquidity. Traders who combine pattern recognition, price targets, and volume confirmation gain a multi-layered approach that reduces risk and increases confidence in their trades. Practical application involves comparing volume to recent averages, noting spikes during breakouts, and observing changes during pattern formation. By integrating volume analysis with previous lessons on continuation, reversal, and candlestick patterns, traders can filter false signals and focus on high probability setups. With volume confirmation understood, traders are ready to explore pattern failures in the next chapter. Recognizing when a pattern fails, why it fails, and how to respond is critical for preserving capital and improving long-term trading performance. Chapter 22: Pattern Failures. Pattern failures are an inevitable part of trading. Thomas Bulkowski emphasizes that no chart pattern guarantees success, and even historically reliable formations can fail. Understanding why patterns fail and how to respond is crucial for risk management and long-term profitability. A pattern failure occurs when the price does not move as expected after a breakout or reversal. For example, a head and shoulders top may break the neckline, but then reverse upward instead of continuing downward. Similarly, a bullish engulfing pattern may appear after a downtrend, but selling pressure may quickly overwhelm buyers, preventing the anticipated reversal. Recognizing these failures early allows traders to limit losses and adjust their strategies. Several factors contribute to pattern failures. Low volume during breakouts is a common cause. Without sufficient market participation, price movements often lack conviction and can reverse quickly. Another factor is external market conditions, such as unexpected news, economic reports, or geopolitical events, which can override technical signals. Additionally, patterns forming near strong support or resistance levels may fail because the market reacts to these key zones rather than following the expected trend. Bulkowski categorizes failures into two main types: premature breakouts and false breakouts. Premature breakouts occur when the price moves slightly beyond the breakout point but lacks follow-through, causing the market to reverse. False breakouts are more extreme, where the price appears to confirm the pattern but quickly reverses in the opposite direction. Both types require quick recognition and disciplined action to minimize losses. Traders can reduce the impact of pattern failures by using confirmation signals. Volume confirmation, for example, ensures that breakouts are supported by significant participation. Waiting for a candle close beyond a breakout level, rather than entering immediately, can filter out false signals. Combining multiple patterns or indicators, such as trend lines, moving averages, and momentum oscillators, increases the reliability of trades. Stop-loss orders are essential when dealing with potential failures. Bulkowski advises placing stops at strategic points within or just beyond the pattern to protect capital. For continuation patterns, stops can be placed slightly inside the pattern boundary, while for reversal patterns, stops may be set near the most recent peak or trough. This disciplined approach ensures that a single failure does not cause disproportionate losses. Psychologically, pattern failures test a trader's discipline and patience. Accepting that failures are part of trading reduces emotional decision-making and helps maintain consistency. Traders who learn from failures by reviewing why a pattern did not work can improve their future performance. Bulkowski also notes that some patterns are more prone to failure than others. Complex patterns, like diamonds or broadening formations, may fail if market conditions change abruptly. Simple patterns, like triangles or double tops, generally have higher reliability, but still require confirmation. Understanding historical success rates and applying probability-based thinking helps traders manage expectations. By mastering pattern failures, traders gain resilience and better risk control. They learn to identify weak signals, respond quickly to reversals, and use stops effectively. With this knowledge, they are prepared to move on to trading tips and guidelines, where Bulkowski consolidates practical strategies for applying all chart pattern lessons in real-world markets. This chapter bridges theory and practice, offering actionable advice for disciplined, profitable trading. Chapter 23: Trading Tips and Guidelines. Trading successfully with chart patterns requires more than recognizing shapes and measuring targets. Thomas Bulkowski emphasizes that discipline, risk management, and practical strategies are essential for turning pattern analysis into consistent profits. This chapter consolidates lessons from the entire book and provides actionable guidelines for real-world trading. One of the most important tips is trade with the trend. Even the most reliable reversal pattern can fail if it goes against a strong underlying trend. For example, a bullish pattern in a strong downtrend may be less reliable than in a sideways or uptrend market. Aligning trades with the overall trend increases the probability of success and reduces exposure to false signals. Entry strategies are crucial. Bulkowski advises waiting for confirmation before entering a trade, such as a candle close beyond the breakout point or a volume spike. Premature entries may lead to losses if the breakout fails or reverses. Using limit orders near breakout levels can help secure favorable entry prices without overcommitting. Stop-loss placement is essential for managing risk. Stops should be set just beyond the pattern boundary, support, or resistance levels, depending on the type of pattern. For example, in a head and shoulders pattern, a stop above the right shoulder protects against a failed reversal. Strategically placed stops prevent small setbacks from turning into large losses. Position sizing is another key guideline. Bulkowski emphasizes that no trade should risk a disproportionate portion of capital. By allocating smaller amounts to each trade and adjusting position size based on pattern reliability, traders can survive losses and maintain consistency. This approach ensures that even multiple failures do not derail long-term performance. Pattern recognition discipline is vital. Traders must resist the temptation to force trades on imperfect patterns. Clear identification, confirmation with volume, and alignment with trend increase reliability. Avoiding trades that are close enough to a pattern reduces the risk of false signals. Monitoring multiple timeframes enhances decision-making. A pattern visible on a daily chart may align with longer-term trends on a weekly chart, providing stronger confirmation. Conversely, patterns appearing only on short-term charts may be less reliable. By combining timeframes, traders gain a broader perspective and better context for each trade. Documenting trades and reviewing performance is crucial for improvement. Bulkowski suggests maintaining a trading journal that records pattern type, entry, exit, volume, and outcome. Analyzing successes and failures over time allows traders to refine strategies, recognize high-probability setups, and avoid repeating mistakes. Psychology and patience are also emphasized. Successful trading requires controlling emotions, avoiding impulsive decisions, and sticking to a plan. Recognizing that not every pattern will succeed, and accepting losses as part of the process prevents emotional trading and preserves capital. Finally, Bulkowski highlights the importance of continuous learning. Markets evolve, patterns adapt, and traders must remain vigilant. By combining chart pattern knowledge with volume analysis, price targets, failure recognition, and disciplined execution, traders develop a comprehensive, systematic approach. Mastering these tips prepares traders to apply all the lessons from the book in practical settings. With price targets, volume confirmation, pattern recognition, and risk management integrated, traders are equipped to navigate real markets with confidence. The next sections, including appendices, provide historical performance statistics, pattern rankings, and an index of patterns, offering valuable references for both new and experienced traders. Appendices. The appendices in Thomas Bulkowski's Encyclopedia of Chart Patterns provide invaluable resources for traders who want to deepen their understanding and refine their strategies. They summarize historical performance, pattern reliability, and offer quick reference tools for practical application. Historical performance statistics show how each chart pattern has performed across thousands of examples. Bulkowski collected data on uptrends, downtrends, breakout success rates, and average price moves. This empirical approach allows traders to evaluate patterns based on probabilities rather than assumptions, helping them make informed decisions. For example, triangles and flags have historically high success rates as continuation patterns, while complex formations like diamonds or broadening tops offer strong signals but occur less frequently. Pattern ranking and reliability organizes patterns by statistical performance. Bulkowski ranks each pattern by factors like success rate, average price change, and failure frequency. Traders can use this ranking to prioritize high-probability setups, manage risk, and decide which patterns to focus on for different market conditions. For instance, simple reversal patterns like double tops or bottoms may be more reliable than multi-swing formations under volatile conditions. The index of patterns serves as a practical reference, listing patterns alphabetically and cross-referencing them with their chapters. It allows traders to quickly locate detailed explanations, examples, and statistical data. This is particularly useful for day-to-day trading, study, and review, making the encyclopedia a functional tool rather than just a theoretical guide. Bulkowski emphasizes that the appendices are not merely supplementary. They are integral to applying chart pattern analysis effectively. Understanding historical performance helps traders calibrate expectations, combine patterns with volume and trend analysis, and avoid overestimating any single signal. By referencing the appendices, traders can compare new market formations against documented trends, improving judgment and confidence. Key takeaways from the appendices include: not all patterns are equally reliable. Historical performance guides decision-making. Context, trend, and volume remain crucial in interpreting patterns. Statistical data allows traders to assess risk and reward more accurately. Quick reference tools improve efficiency and support real-time trading decisions. By integrating insights from the appendices with the lessons from all 5 parts, traders develop a complete system. They can recognize patterns, measure price targets, confirm with volume, anticipate failures, and apply disciplined trading strategies. The appendices ensure that theory meets practice, providing a bridge from learning to executing trades effectively. With the appendices, Bulkowski closes the encyclopedia with a comprehensive toolkit. Traders are now equipped not only to identify patterns, but to apply them intelligently, manage risk, and approach the markets with a structured, probability-based strategy. This completes the journey through chart patterns, from foundational concepts to advanced application, empowering traders to make informed, confident decisions in any market condition.